Well, let's talk about what's going on right now in the stock market. Last week was an adjustment to higher interest rates. This is just the simple math of discounted cash flow models for future earnings, right? The value of those future earnings goes down as interest rates go higher. The market was surprised by what the peak rate was coming out of the Fed meeting. But this week is something different that's going on, and it's temporary in nature, but it's going on. These currency moves are kind of freaking out the market because usually when you see the British pound move as much as it has the last few days, usually some financial player gets carried out feet first. So far this year, you haven't seen that. You've seen crypto malaise geolocated within the crypto world, but there's worries whether it's a hedge fund, a non-bank financial player, that somebody's going to get beat up and cause a systemic risk here. Hopefully, we can get through the next 2 weeks without that happening. The market may gain footing on the belief that whatever the Fed does, it's going to be over by the next 3 months. We've got 3 months left in this year. The bulk of the Fed's heavy lifting is likely to be done by the end of the year.
This is like a bond yield induced move lower as we're having the conversation, I feel like, right? The 10-year is 3 basis points and change away from 3.5 basis points, 3 3/4 away from 4%. All you have to do is watch bond yields to determine, Michael Farr, where stocks are going to go, at least in the time being.
I mean, that's pretty much right. And while Jeremy Siegel, I think, espouses a lot of the frustration that's being felt by a lot of investors, because investors realize, look, the Fed's pushing up those rates. That's pushing down equity prices. It's slowing the economy, but it's doing exactly what the Fed wants it to do. And Professor Siegel's saying, stop. This is enough. And maybe he's right. But there is another cohort that thinks that you have to take rates to 5% for the Fed funds rate. Dr. Jeffrey Lacker, former president of the Richmond Fed, thinks it could be north to hit that sort of neutral rate out there. It's not a voice any of us want to hear.
Right.
But, yes, what we need to do is watch that bond market, watch where those yields are going, and I'm noticing here, too, Judge, that everybody's shifting to the fearful, this is awful side of the boat. We're all singing from the same page. We're even working just on our harmonies about how bad things are right now. It's always kind of risky when you all get on the same side of the boat, but it's riskier if you're not on the Fed side of the boat. Don't be on the wrong side of the boat from the Fed.
Well, a lot of people are moving on one side of the boat, right? Our Delivering Alpha conference is tomorrow in New York City. We have the Delivering Alpha Investor Survey. Is the Fed moving too fast on rates? 35%. Yeah, it's time to slow down. Next, what is your biggest concern for the markets right now? Of all the things that are out there, Taiwan, China, energy in Europe, midterm elections, job market, no. 58%. Fed being too aggressive. So it's in the zeitgeist of the market at this point, Josh.
Well, it's the most powerful player on the board. So, like, you ask a question, like, what are you, like, if you're playing chess, what are you worried about? Yeah, of course, you're worried about the pawns, you're worried about the knights, you're worried about the bishops. But, like, in the end, your eye is on the queen. This is the piece that can do anything. And unfortunately, we're in a situation right now where the Fed thinks its job is to earn back its credibility. This is the craziest S that I've ever heard in 20 years in this business. This idea that they will ever have credibility ever again, this currently constituted Fed board, you could throw that out the window. I heard Nick Timiraos on a podcast this week has probably spent more time talking to Fed governors this year than any other reporter. And they ask him, like, what's Powell's feeling right now? What's his personality trait that people most associate with him? He keeps going, oh, Powell's confident. He's so confident. What is he confident for? Like, what is the source of that confidence? I don't think we've seen a Fed have to go back and forth this many times in a 4 or 5 year period. It's a complete circus, and credibility is not the issue. It's almost like a perversion of capitalism. It's a guy, he's an attorney who used to work in the private equity space, and he's going to sit in a room and figure out how many truck drivers and nurses need to lose their jobs.
Stop it. If he was an academic,
what are we doing?
If he was an academic, the criticism on the other side would be, oh, he's tanking the market. He doesn't understand the markets.
Well, he's already done it. So we've already done this. We've done this game. Jim cited the 2018 example. We've done this game multiple times. How many times can you be wrong before you just say, you know what? Maybe this data-dependent thing isn't working out, and it should be common sense dependent. Common sense is, historically, you give the rate hikes an opportunity to work some effect before you pile on the next set. So I understand we were late. This should have happened before. Okay, but that's the past. You can't go back in time. So the solution is not, well, you know what'll really cool off inflation if I completely crash the economy. Like, that's not the right medicine for the situation.